Well, thank you, everyone. I'll introduce myself. My name is Ravi Sood. I'm the Chairman and Chief Executive Officer of Golconda Gold. I'm going to quickly take you through our presentation today. Very excited to tell you about how we put the company together and what we're doing today with our two mining operations, one in South Africa and the other in New Mexico in the United States. All the pictures that you'll see in this presentation, none of them are stock photos. They're all actual photos from our various operations. So very proud to share these images from you and, convey hopefully that it's a living, breathing thing, very much in operation and with a lot of complexity to it. So there's a lot of work gone into getting ourselves to where we are today. And I think it's an important part of our story, just sort of the value between a great project that's really on a spreadsheet and on a PowerPoint and a great project that's actually built and running. It's a big gap, and there's a heck of a lot to accomplish in between those two points in time. So just very briefly on the corporate structure, we have 71 million shares outstanding, almost no options, about 5 million deferred share units held by various members of management and the board, no warrants outstanding. We have a small but growing cash position. This is our capital, our fiscal position has improved dramatically over the course of this year as our production's ramped up and we've benefited from the gold price. And one of the most important parts of our story is our insider ownership. So over 40% of the company is held by insiders. I'm the largest shareholder. Other members of management and the board are also very large shareholders. And this means, one, we have a tight capital structure, but more importantly, it means that we're very much aligned with other shareholders. So whatever we get paid for salary or if any other form of compensation, it's dwarfed by the impact on us by the movements up and down in the share price. So doesn't mean we're infallible or incapable of making mistakes. Obviously, we are. Like any management team, but you can at least have faith that we're very much aligned with trying to increase the value of the shares with a very long-term horizon, as opposed to trying to increase the value of the shares in the short-term horizon or do something that would otherwise benefit us financially. So two operations, one mine running, the other will be running. We're targeting the end of Q2 2026. Both were purchased out of restructuring processes. So we would argue that we purchased them very opportunistically, and again, very much part of our story and our ethos as a company, our DNA, is that we see a lot of opportunity and value in buying operations that have existing infrastructure and, very importantly, are permitted. So huge value to that, notwithstanding an improved environment for mining and permitting mining projects. It's still very difficult to get these permitted. It's a variable that's hard to manage because it's largely out of the control of a management team in terms of how long it will take to permit an operation. So huge value in buying past previously operating projects. So South Africa, we acquired a number of years ago. We have a very large resource there. This is quite a historic asset, one of the oldest gold mines in the world, and in operation in some shape or form for over 100 years. We have a very modest production plan. This year we'll produce just over 10,000 ounces. We are scaling up over the next several years to produce just over 3,000 ounces a month. So to get close to a 40,000 ounce a year production profile. We can't do it much faster. It does take us several years to do that with the nature of our mine. But we have an extremely long mine life ahead of us. So with a resource base over 2 million ounces, with that modest production profile, very long mine life. And the resource doesn't stop there. We could certainly extend it quite significantly. The other operation, the one that we're starting next year, is the Summit mine. That's in New Mexico in the United States. So similar underground, in this case, roughly 50-50 gold and silver. So new component for our revenue mix for us, getting that significant exposure to silver going forward. Relatively small resource base, but one that we're very confident and optimistic we can expand and extend dramatically. So we have a short mine life here, 7 years. We see a very clear path forward to expanding that resource, and in fact, ultimately expanding our milling capacity as well, which would allow us to mine more, produce more, and potentially also toll mill ore coming from other mines in New Mexico. There is a lot of potential for gold and silver in New Mexico. There are no other standalone gold and silver mines other than ourselves. There will be. And the hardest part is going to be for them permitting their milling operations and their tailings facilities. So we already have a permitted facility. So that's a huge advantage and value for us there. Just high level, why are we a compelling investment? So we are a producer 365 days a year, barring any incidents. We're producing gold. So certainly anybody in the sector, every boat will be floated by the rising tide. If gold and silver keep going up, it'll benefit everybody, no question about that. But our balance sheet, our financial statements we are more directly benefiting financially from the high gold price environment. We do not have to depend on capital markets to fund any of our expansion or fund the restart at Summit. We're doing all of that out of existing cash flows from operations. So direct exposure to gold, lots of leverage there. Number two, we have organic growth. So we're roughly tripling our production profile in South Africa. Again, organically out of existing cash flows, existing resource, existing infrastructure, and also bringing on Summit in the United States. So lots of growth and diversification there that's built in. You don't have to wait for us to do another deal or raise some money. And finally, as I highlighted earlier, the high insider ownership, very much aligned with shareholders. So maximum leverage to gold, organic growth, and very good alignment with management. So Galaxy, just very briefly, this is an underground mining operation. It's a number of ore bodies here. There's 21 different ore bodies. We're only mining at 2 of them currently. At 3 faces, we're going to 4 faces by the end of this month. And you'll see that us slowly expand that over time, which is going to allow us to get more ore from more faces to our mill. Our mill is a 50,000 ton per month capacity. This year, we've averaged just over 10,000 tons a month. Next year, we'll be just under 20. So you can see we have huge unutilized capacity at that mill. What does that mean? That means we can keep expanding. We can double and triple our current production without any material Capex to our mill. So big benefit there. A little bit of before and after here. So we took over an operation with substantial infrastructure, some of it usable, some of it not. We've upgraded, we've improved, we've replaced, and we've refurbished. And so now we have an operation that's got many, many years ahead of it with the existing infrastructure and a lot more capacity to grow. A little bit more before and after, just showing what the operation looks like. And just looking a little bit on our projections in 2025, which is the first column here, this is almost an actual at this point. So, we have a pretty high degree of comfort, and the reader can look at our Q3, which we put out to the market a couple weeks ago, and refer to the production numbers there and see the production ramp up and infer where we might be for Q4. This is at a $3,000 gold price and $35 silver, which seemed a bit aggressive only a few months ago, but here we are at almost 50% higher on gold, and in fact more than 50% higher on silver. So huge benefit to us. It means we become fully taxable sooner, so it doesn't all fall to the bottom line, but not a bad news story. Paying more tax means we've made more profit. So huge leverage to gold, huge profitability at even these much lower prices, and more than self-financing. If you can focus on the free cash flow row, you can see that this just Galaxy produces a huge amount of free cash flow, even this year, but certainly in the coming years as well going forward. Just to, in stocks never trade, mining stocks typically do not trade at their NPV, maybe with the exception of royalty stocks, which trade at a premium. But, looking at today's gold, if we use $4,000 gold, the net asset value per share of our Galaxy operation alone is over $6. So a lot of value there. Again, this is spreadsheet value. It doesn't mean that stock's going to trade there. Mining stocks do not trade at 1x NAV, but lots of value there. And you can see the leverage to the gold price. An extra $1,000 on gold is almost adding $3 of NAV per share. So big gaps there. We do have what's called the Black Empowerment Partner, which in our case is a microfinance institution that provides loans, micro loans to female entrepreneurs in the community that we operate in. So great group for us to work with on a go-forward basis. Summit Gold Mine, this is our asset in the United States. And this is, we hope to put this back into production in the end of Q2, with first mining in Q2 and first production of gold and silver in Q3 of next year. We think this is a very achievable plan. That this mine was in production up until 2013. It went into creditor protection. It had a huge amount of debt and other obligations that it couldn't meet realistically with when the gold and silver prices declined sharply in 2013. So that created an opportunity for us. It sat for about 10 years in care and maintenance, very good condition in the arid to semi-arid conditions where it's based in New Mexico, and we acquired this mine. We ourselves kept it on care and maintenance the last several years, and we're looking for an opportunity to bring it into production on an accretive basis to us. So we didn't want to have to issue stock to raise money to finance the restart. We looked at different solutions where we would borrow some money to do it. And as 2025 progressed, we could see ourselves paying down all our historic debt, accrued payables, and generating substantial free cash flow, and realized that in 2026, we could bring this online, not only without issuing any equity, but most likely without any borrowing as well. Just completely finance it out of the cash flows from our existing operations. So really de-risks it in a couple ways. One, financially, obviously, makes it more accretive or fully accretive. Number two, no risk of us not being able to raise the money because we don't need to raise any. And number three, from an operating point of view, when you're operating against interest payments and looming principal repayments, that's one way of running a business. If you're able to run it knowing that if you're off on your budget and it's going to take an extra 1 month, 3 months, even 6 months to accomplish some key objective, and that's just the way it is, then you can do it. You can sit down, recalculate, and make it happen. If you're doing that under the weight of debt sitting on your head, it doesn't mean it's impossible. That's the way most operations do things, and it's maximum leverage for shareholders for sure. But it is an additional level of risk. So we're very happy that we're able to tackle this restart and do it from a very strong financial position. It's in gold equivalent ounces. It's going to produce approximately 1,000 ounces a month, or an average of 12,000 ounces a year. That's roughly 50. It's a little bit more gold than it is silver, but that'll go up and down depending on the gold and silver price. This company had itself over 100 million US market cap, so roughly our current market cap by itself, and it had a huge amount of debt when it had that. So that was in the context of $1,600 gold and $30 to $40 silver at the time. And here we are with much higher commodity prices, no debt, and about to restart this. So we're very excited about what this could do for our value, our actual value, and also our perceived value in capital markets. Adding an operation in the United States, of course, very exciting to many. You can see the condition of the mill, indoors, extremely good condition. It is running as we speak. We can turn it on and it's operable. Very little additional work needs to be done other than just general cleanup. It was left in fantastic condition. Very simple mining operation. This is much simpler than our operation in South Africa. Not much concern here. And this is us basically supplying on the order of 6,000 tons of ore a month to our mill to hit our targets. So high head grade, lots of opportunity to extend the mine life and to extend the volumes too in the future. So very modest target for 2026. Just 2,000 ounces. That's the top row here. We see where it says Summit as gold equivalent ounces. And that number sort of fluctuates depending on where we are in the mine plan in the years to come. This mine plan assumes that we're shutting down in 2032. I would suggest that will not be the case. I can't present anything other than a compliant mine plan. So this is what we have on the screen. So I would anticipate our production not to have that spike up in 2031 and 2032. But for good reasons, because we're not shutting down and taking out the crown pillars on our way out. It's because we're going to be there for another 10 or 20 years because we've dramatically extended the mine life. So lot of potential here on this one. Even with the very modest production profile and the $3,000 gold price and $35 silver, you can see the profitability generating a lot of free cash flow for us. Of course, this is all in US dollars. And then taking a look, we're even off the table here that we made on silver, with silver at $60, literally 33% higher than our high end number here, 45. But you can see again, lots of leverage for Golconda shareholders on Summit to the gold and silver price. Every $10 in silver, kind of adding $20 million or $25 million of net present value. And here we are, almost another $20 higher than our high end case. So lots of leverage here, lots of opportunity. Exploration, I'm not going to go into much detail other than from where I sit, Nevada or New Mexico should be more like Nevada in terms of gold and silver production. It isn't. It's a different government, different sensitivities around permitting, but geologically the potential is enormous. And a couple hundred years of mining history and lots of high grade deposits that are out there, some of them known and some of them yet to be found. But there's certainly a lot of opportunity immediately around us. And the fact that we have a fully permitted mill and tailings facility is a huge strategic value to us. So one other consideration, which is I'd say beyond consideration and would be our baseline plan at this point in time, is once we have Summit into production and profitable and washing its own face, so to speak, we will spin it out as a standalone US-only gold and silver producer. So our belief is, based on comparables, the value of Summit as a standalone company would exceed that of all of Golconda right now, just based on where things are trading. So again, another potential huge value creator for us. So just looking at a consolidated basis, so I won't go over this too much again because we went through the pieces already, but looking at our free cash flow numbers, you can see, as I said, 2025 is almost in the books here. And I'm very comfortable with that number and would be very surprised if it's that low when we come to the end of 2025. But the substantial free cash flow generated even this year on a very modest production base. And you can see 2026 over 2025, almost exactly doubling our production. And I would assume a much higher gold price in 2026 than 3,000 and higher silver price than 35. And that translates through the reader can draw their own conclusions as to what that could mean. Obviously, very positive for our business. Again, paying more taxes for sure, paying more royalties, but it will leave us in an outstanding position from a cash flow generation point of view. Similarly, net asset value or NPV per share, looking at the $45 silver and $4,000 gold. I guess this is closest to where we are, still below, but that's over $8 a share of net asset value on a combined basis. So, and that factors in our corporate overhead as well. So lots, again, that doesn't mean the stock's going to trade there. That's not the case at all. I've never seen a mining stock trade at its NPV 5, even in a takeover. But it is a good indicator of what the underlying value of the business is. So just summarizing, value creation arc for us, self-fund our ramp up in production at Galaxy. So round numbers, tripling that over the next 5 years translates to more cash flow, more cash piling up on our balance sheet. Number two, can pull off the restart of Summit in Q2 next year. Give us that operation in the United States, bring silver into the mix for us. Number three, spin out Summit. If it doesn't make sense at the time, we won't be doing it. But as it currently stands, it absolutely would make sense and would really be a huge value creator. And finally, as more of an overarching observation, we'd love to do another transaction like a Galaxy, like a Summit, It's fewer and farther between now with a very bullish and positive environment for gold and silver. So it's going to be harder to find that deal. But in the absence of a deal that sort of looks like that, where we have huge leverage for shareholders, we would look to start to return that capital to shareholders. And in the first instance, probably through buybacks. We did cancel over 400,000 shares this year. We were able to in a one-off transaction, roughly something like 0.5% of our shares outstanding, so not insignificant, and ultimately dividends. So that's not a discussion for today, but in the not too distant future, that will come into play. And with that, that's Golconda Gold, and looking forward to talking a little bit more about our strategy and where we're at going forward.
Fantastic. So, Ravi, could you tell us a little bit more about yourself and about your career?
Absolutely. I'll call it a career of two halves. The first half, roughly 15 years, was spent in asset management and capital markets. So I worked for an investment firm based in Toronto, ultimately as the CEO. And there we managed a variety of mandates: venture capital, oil and gas, income, hedge fund, and through a variety of funds that we raised capital for and managed. And I sold that company in 2009, so just over 15 years ago. And since then, I've been focused. I've done a very small number of, I'll call it deals, investments that I've made, where they all have a similar flavor, where I've bought an initial asset that was non-performing or for some reason non-core from a big company, and that's taken me all over the world. I bought Unilever's business in the Congo. I bought a business in Liberia, and I formed Golconda Gold by buying a non-core mine from a big mining company. I've also sat on the board of a small number of companies over that time period, usually for other entrepreneurs or people, investors that I have a close relationship with or I've been closely associated with over the years. But a number of them in mining, Elgin Mining, which Phoenix Coal, we had coal mines in the United States. We sold those assets. Elgin Mining, we had a gold mine in Sweden, the Björkdale Gold Mine. Sold that company to Mandalay Resources in 2014. We had, I was on the board, I was the chairman of ICC Labs, which we sold for almost $300 million in 2018. And True Context, later called Pronto Forms, a software company that was also acquired. So for the most part, on the board for a number of years, helping with the capital market strategy and also helping on the ultimate exit. So that's just sort of a ancillary activity for me. My day job is certainly Golconda Gold. It's my largest part of our family's net worth and our largest investment in terms of cost base, but also by a wide margin in terms of market value. And it's where my focus is.
You have a very large, high insider ownership here in Golconda. How much is owned by yourself?
So in my name, right, directly, just over 10%. I'm also the sole heir to my father's estate, which will resolve in the next couple of months. I don't know exactly when, but it's just sort of a legal question. So that will show as me going well over 20%, almost to 30% when that's now passed down directly into my name. So that it won't be me buying. I effectively own those shares already, but that will clarify that situation. So I'm just under 30% myself and my family in terms of direct ownership. The other another board member owns a very large position, and then the rest of the management team, adding all that in, takes us over 40%. So I could say for each person involved, it's their largest investment. So it's a major consideration for everyone, and it's not lacking for attention due to size or significance to anybody's portfolio or personal financial situation.
Excellent to hear. So could you give us an overview of how Golconda got started and give us a brief, walkthrough of how we got to where we are today?
Yeah, and I think that's a great build up to why it is or how it is we do things. So I formed the company, as I'd alluded to earlier, by buying a non-core division from a big mining company. In our case, I was contacted by IAM Gold in 2010. They had an operation in Botswana. which they'd purchased for $240 million in 2006, and was very important to them. It was their first operating mine inside of IAMGOLD. And $240 million was roughly half their market cap at the time. So it was a big deal for IAMGOLD in 2006. But by 2010, it wasn't a bit, it was too small for IAMGOLD, and it was facing imminent shutdown just due to end of life on the mine. So it had about 18 months left in the mine plan. So I took a look at it, and I saw a lot of opportunities. So number one, it was very much look, IAMGOLD's a great company, but you're not going to get much airtime with them at the board level or any other level if you're less than 5% of the revenue, and that's where this company was at the time. So I'd say it was undermanaged with a lot of obvious opportunities there. It also had this very short mine life, but the work done on this one, remember, it had gone into production in 2005, bought by IAMGOLD in 2006, started construction in 2001 based on geological work and exploration done in the 90s. So in the context, that exploration work was done in the context of $250 gold. When they did their feasibility, the range was $250, $275, and at the outside was $300 gold. So you can imagine that they had all these results, which were throwaway hits, like 2 grams a ton. We're not going to look at that. That's too low. So stuff that was obviously going to be economic in the context then of $1,800 gold. So we saw, okay, it's not going to be 18 months mine life. We're going to get 3-4 years, maybe much more. So I bought it on that basis. I paid $10 million cash and a $5 million deferred component, a note payable, which we ultimately paid to IAMGOLD out of our cash flow. So just in my comment earlier, I said the value to being, going from something on a spreadsheet and a PowerPoint to something that's in operation, all those permits, so the construction, all that time risk, all those unknowns is enormous. And IAMGOLD, a smart company, gold at $650 an ounce, paid $240 million, and 5 years later sold to me for 15, 10 upfront, 5 back-ended. Why? It was too small. They didn't care. And it was coming to the end of mine life. Guess what? We ran it for another 11 years. And it was still running when we sold it, which was three years ago now. So why did we sell it? So we saw our average production was about 30,000 ounces a year. We produced 332,000 ounces over 11 years. We averaged our AISC over that time period was just under 1,400. And our average realized gold price over that 11 years was just under 1,400. So we more or less broke even. So we vastly exceeded our targets in terms of mine life extension. We exceeded our internal targets and our projections that we gave anyone in terms of getting the cost down. And we still didn't make any money. So that's the sad part about the story. But again, showing look how many hundreds of millions of dollars have gone into this operation over the years. And it's still hard to make money in the gold industry, telling me as an investor, first and foremost, that you really need high gold prices. The gold price has not been conducive for most of the cycle for anyone to make money. And it's been very difficult for a very long time. But the happy part of this story, if there is one, and I think there is now based on how we're doing, is while we had that asset, I was able to put the band together. We had a public vehicle, we had a management team. We could diligence opportunities, and we could chase down transactions. And we bought Galaxy and Summit. So 2 more in the same vein where we said, okay, well, this is worth a lot more than it should be, or that's being valued at. They're kind of in the who cares bucket for most people. First of all, both are underground. So a lot of people are just, well, okay, we don't have the skill set. We're not going to do underground mining. Great. A lot of the gold mines going forward are going to be underground. They're easier to permit. And a lot of the easy open pit stuff has been done already. And it's getting harder and harder to permit. So no problem. We'll continue to focus on being underground guys, but you lost a huge part of your audience there. Number 2, they're small. So, no majors, no intermediates. And a lot of entrepreneurs who have had success in the past, not going to bother. So that shrunk the audience by 50%, 80%, 90%. You're down to a very small audience. and then the credibility or capability of the people in that audience to, number one, raise the money to buy it, and number two, actually put it into production afterwards, which is an important consideration, shrinks it even further. So what does that mean? If your universe of buyers just went like that, like this, then your purchase price also went like this. So if I'm not out to show off to people like how many ounces we produced or how big our NPV is, and I'm out to actually make money and make a return on my money that's invested in pulling this off and risk adjust it, because I can show you a spreadsheet with some great project. There's enormous returns on it, but I got to do this, and this, and this. The more thises I add to the list, the less likely I am to get to that pot of gold at the end of the rainbow. So that's very much how we approach things now and going forward. We started off with that transaction, saw a lot of value in it, being in production and extending that, and we're able to kind of do some version of the same thing 2 more times. And the clock ran out us on the first one. Gold was at $1,300, $1,400. We sold it. We didn't lose any money, and we covered our costs. We put the band together and we bought 2 other mines, which are now in production and about to be in production on the back of that first one. So that's the 14-year genesis overnight success of Golconda Gold, 14 years in the making. It's very much in our DNA. So that way of doing business and that approach to things is not going to change.
Could you tell us a little bit about your technical team and how you put that together?
So the team is very much, from an operational point of view, everybody's in South Africa. We are now staffing up. We expect to announce our first hires imminently in the United States. There's a limited amount. We can support a little bit of the operation in the US with our team in South Africa, but obviously not day-to-day operations. You have to physically be there. So that we'll have our first big hire announced before year end. And, we'll be announcing and filling more positions as we go into our start date at the end of Q2 on Summit. But the core technical team was, started coming together while we're in Botswana, and really high quality, experienced individuals from South Africa. So a lot of experience, not just in South Africa, but throughout Africa and indeed internationally in Asia, Europe, and elsewhere. And that team's held together. Several people have worked together on that team for over 20 years, in some cases over 30 years at different locations around the world. So we've got a very good working environment. We're in a place which is unusual for mining, in that we're more or less in a city, and a very nice one. There's macadamia plantations, beautiful green rolling hills and mountains, very nice weather, sealed roads, all amenities that a city would have. I think we're about 50,000 in Barberton where we are, and about an hour away is Nelspruit, which is the gateway to Kruger National Park. It's the airport that you land. It's an international airport. I think about 500,000 people there. So you usually don't get that in mining. So it's a very nice place to be based. So we've been able to attract a very good team and keep it together. We hired, we are continuing to hire. So I think we were in the mid 200s going into, in 2024, we're exiting this year at 320 as our headcount in South Africa. And we'll probably peak over 400 as we ramp up the operation. So a lot of leverage there. Same overhead, same geology team, same maintenance team, all that sort of stuff is kind of like a fixed cost, and now getting amortized over a larger production base, which is what you want to see happen.
So let's move to the financial position. You have 3 million in cash, USD, and 2.6 million debt. What's the plan for the debt? And also, obviously, the cash position right now, at least, is quite small relative to your market cap. So if you could give some color on that.
Yeah, and we've never been in so strong a position. So we started the year with quite a bit more debt. We've just cash flowed our way out of it. That last piece of debt is due in March. So we've got enough cash reserve to cover that off, pay that out. And we're adding cash on a monthly basis now to go up and down with gold price. But every month we're going to add to cash at this point. So we have no debt left to repay. The big parts of our capex are behind us. We still will always have capital expenditures, which will be associated to underground development. That is a forever thing in underground mining. It's basically part of your AISC or even part of your operating cost, really. And so we'll always have substantial underground mining expenditures. But we're in cash add mode at this point, so we're very comfortable with our financial position. As I said, we'll be adding cash while we're expanding Galaxy and restarting Summit, and we'll still be adding cash in 2026. So very, very comfortable from that point of view.
Excellent. So the debt should probably, we'll see when, but it should be reduced in the future.
It'll be gone in March. Yeah, so that's just it's not easy for us to prepay or repay it early. There's not much incentive to do so either, but that'll be gone. By the time we release our next financial results, which will be our 2025 annual audited financials, we will have repaid. It'll be a subsequent event note, but we will have repaid that debt. It'll be gone. So we'll be debt free by the time we're releasing those.
And also, how much with Summit going into production next year, you're making new hires, how much do you expect to spend on G&A next year?
The G&A will not change. So we did a little bit of internal benchmarking, and it's a little bit of apples to oranges, but we looked at every producer that we could find in Australia and listed on the TSX, and we had the lowest G&A of any producer. So we're at 2.2 million USD, and we just approved our budget for next year. It's the same. Why is it not going up with the addition of Summit? Well, we already have Summit. We've had it for several years in terms of a corporate entity, having to deal with it from an audit perspective, lawyers in the United States dealing with it from that perspective. So that doesn't change. On an operating basis, like Capex and OpEx at a Summit level, that does go up. But from a corporate overhead point of view, that won't change. Maybe we spend an extra $100,000 on U.S. legals or something like that, and a little bit more on the audit for the U.S. operation once it's become gone into actual operation. It's a more complex entity to audit, but no material change there. So very low. And the reason why I said it's a bit misleading or apples to oranges is we are a small producer. So of course, Newmont is going to have a larger corporate overhead than we are, producing whatever millions of ounces of gold a year. But we'd like to start tracking that on a per ounce basis. And it'd be interesting to benchmark G&A on a per ounce of production basis, because the numbers based on just a quick observation are all over the map. And it tells you something about the management team and the management structure, depending on what that result is.
I mean, obviously you make most of your money, or essentially all your money, through share appreciation and not through your salary. So
I could say a 1 cent move on the share price is equivalent to my salary. So
very good position and very, very aligned. So let's move to Galaxy. What streams and royalties are on Galaxy? And you can also answer the same question for Summit while we're at it.
So I'll answer Summit first because it's easier. There are no streams or royalties, and we'd like to avoid that. In the case of Galaxy, there's both. And the history of, on the royalty side, that's a government thing. So the South African government has a royalty. It's 7% royalty once you're profitable. If you're not profitable, there's a nominal 0.5% royalty that you have to pay, even though you're losing money. But once you're profitable, which we are, then you're paying this pretty large royalty. It just is what it is. It's already in our numbers. I'd say these things are kind of like a positive. Like there's a lot of concern about. Obviously, I'd rather have a zero risk situation where I don't pay any tax or I don't pay any royalty, but that doesn't exist. The reason why I say it could be a good thing is that, there's a lot of, we've got concern of like, well, is South Africa a good jurisdiction? About 40% of the gold that's ever been produced in the history of the world has been produced in South Africa. So clearly from a geological point of view, it's a good jurisdiction for gold. It has declined consistently as a gold producer on a relative and absolute basis. And the reason for that is like there's just been less people interested in doing business, and it's been harder to do business in South Africa. However, there is no precedent or evidence to show that they've ever nationalized or taken away assets from anyone. That's not been the case in other countries. One of the reasons is you're profitable there, you pay tax, you pay a relatively high royalty. We have a minority interest being our Black empowerment partner. So those are costs of doing business for us. They're already in our numbers. They are what they are. But they're all positives for the community and for the government. So they are benefiting directly from a higher gold price and from our operating success. So there's less, to be honest, I'd rather be them than me. We have to do all the work to earn the profit, and that's it if it all works out for us. And they're getting a big slice of the economics without doing the work, and it's actually a pretty sustainable, positive situation. So that part's good. It just is what it is because that's a government royalty. There's nothing to do about that. We did do a stream with a company called Empress in 2000. We signed the deal in 2023. Gold prices were much lower. We were really struggling to keep things together and keep things moving forward at Galaxy. So we raised $5 million. It was non-dilutive. Our market cap at the time was below $10 million. So you can imagine, first of all, it wouldn't have been available from the equity market. And second, it would have been horrifically dilutive if it was. So that was, even with the benefit of hindsight, in the fact that I hate to give up ounces, that was the right thing for us to do. And it's got us to where we are today. So that $5 million was a big deal to us in 2023. I wish I could buy it back. I can't. And basically the deal is they get 3.5. They pay us 20% of spot price for 3.5% of our production is what we're streaming to them. So if we're producing 10,000 ounces, that's 350 ounces.
Is there any drop down clause to that?
It drops down the total number of ounces to be delivered. The stream goes for 20 years or 20,000 ounces, whichever comes first. And it'd be a race to the end there. It should take us about 20 years to deliver them 20,000 ounces. That's us averaging sort of, you can do the math on that. So 20,000 ounces over 20 years divided by 0.035%. But it does step down to 2% after a threshold. But we're about, I think, another 8 years out from hitting that threshold. So in the foreseeable future, we're at 3.5%. With Empress. So it's up. It's already in our numbers. It's working, and I'm on one hand very grateful that they were there, and we wouldn't be here without them. And I also wish I had it back because it was a great deal for Empress.
What does the ownership structure look like for the Galaxy mine?
So we effectively own 74%. We meaning Golconda, and the rest is it's sliced into different pieces, but called Black Empowerment Partners, or BEE. And that was a program designed in the post-Mandela era and post-apartheid era in South Africa to transfer ownership over a long period of time to previously disadvantaged people. And no comment on the success or failure of the program, but in our case, sometimes people would bring in a partner that was very politically connected or sort of very powerful, and would qualify under as Black empowerment rules as a previously disadvantaged group or person, because they needed to get pushed through a permit or get something passed through government. In our case, we bought a permitted operation. It was on the other side of that chasm. And so when we structured our Black empowerment partner, we picked a group that we thought would be highly impactful to the local community and would be positive for a long-term social license and ability to operate in that community. And that's why focusing on putting money in the community through microloans, number one. Number two, through female entrepreneurs, which just candidly has lower fraud risk and has been shown, the data has just shown that it's has a higher impact and so more positive outcomes associated to that. So on one hand, it sounds good and it looks good in a slideshow. On the other hand, it's a very real positive impact over time, which is what I was trying to accomplish. We have not paid any, we have like a nominal support that we give to that organization to date. We are still recouping our capital, burning through historic tax losses, and getting to the point where we have recouped all that money, which get all our money back and with interest sort of thing first. And then as we dividend money out of the operation, again, already all factored into our numbers and our projections, and you see it in the projections that we provide to people, they would be a substantial part of those dividends paid out according to their pro rata interest. And that would be money just going directly into the community that we're operating in. So again, long-term, hugely positive outcomes and positive for our social license.
So how much of the free cash flows do you get now, and how much, when will you actually get your pro rata, which is 74%?
So we'll recoup to pick your gold price, but assuming we're hitting our projections, it'll be sometime at the $3,000 gold. It wouldn't be till near the end of 2026. $4,000 gold, I think, kind of the end of Q2. So we'll have gone through, I think we started 2025 with 29 million USD of tax shields, and roughly the same in terms of intercompany debt. So like basically money we pushed down or was pushed down by people before us when we bought it, because we haven't put $30 million in. And but people have over time. That's why that historic debt's there that we bought. That will all have been repaid and all those tax shields burned through. And again, I wish I lived in a world where I didn't have to pay tax, but it's a good thing, and that means that we're truly profitable. So it's recouped all of its historic losses and capital going in, and covering all its costs and paying taxes.
You produced 13,000 tons per month. For process that in Q3, you will be ramping up in Q4. 2,000 tons per month, which equates to roughly, I guess 18,000 ounces per year if you have that run rate. When do you expect to be there?
So we'll hit the run rate kind of towards the end of Q1. We are ramping up already in Q4, and in Q3 you saw the addition. We've already added a third face, which we refer to as Princeton Top. We're adding a fourth one, which we refer to as Galaxy 26 level, or you could call it Galaxy Bottom to keep the same nomenclature, but it doesn't sound as good. And we'll continue to add faces. And what does this mean in underground mining? And we often get the question, well, you have over 2 million ounces of resource, and you say you could increase that further. Why are you producing so little? Can't you spend more and just either produce more or get to your ultimate run rate faster? This is underground mining, so it's a bit of a different beast. And you can picture you have a adit going into the ore body, and a certain amount of tons can come out on a daily basis. A certain amount of ore can be blasted on a daily basis. You can't blast 16 times. You can blast, you can remove, you can blast, you can remove. It's just a physical constraint. And so how do you expand your throughput? You open up more faces, and then you can get more tons out. So important at the back end is what's our plant capacity, what's our milling capacity. So we're built to 50,000 tons per month. 2025 will have averaged 10,000. Next year, we're roughly doubling it, as you said, to getting towards a 20,000 tons per month number. We'll still only be at about 40% capacity in our mill. So we have a lot of room to grow there. Since we have that capacity, obviously we want to get to it. So over the next 3-4 years, you'll see us adding more faces, different ore bodies. Like I showed you that diagram with 21 different steeply dipping ore bodies. So we can at times access the same ore body, like Princeton Top and Princeton Bottom, two different places, mine down and mine up. So that is absolutely possible, and we are doing it. But we can also access the different ore bodies as well over time. So that it's all built into the plan. It does a bunch of very positive things. So number one, more ore. More tons equals more ounces. Very good thing. Number two, we're in a greenstone belt. Over an annual basis or even a quarterly basis, we're pretty good in terms of predicting grade. On a weekly basis or monthly basis, our grade can surprise us to the upside and downside pretty dramatically. So that just is what it is. Again, underground mining, it's the nature of it. But portfolio theory, as we go from one phase to now 3 going on 4, and you see us at 6, 7, 8 phases, one will be up, One will be way up, the third one will be down, fourth one will be way down. On average, the volatility should actually go virtually to zero. So instead of being pretty smooth on an annual or a quarterly basis, we'll get smoother on a monthly basis and maybe even on a weekly basis. So we don't have much variation in how many ounces we're producing. That is also a good thing in terms of managing your business, managing cash flow. It's unambiguously positive.
Is there anything else you're adding besides more phases and I guess you also more equipment, to get to essentially double your, or you're more than doubling your throughput, but to get to that 50,000 tons per month, in a few years.
Yeah, we can do a bit better at each face. So that means more equipment at the face that's running. So it's a combination of more equipment and also better equipment that's operating with higher availability. What does that mean? Well, that means you may have all the right machines, but if they're only operating 40, 50, 60% of the time due to maintenance issues, you're not going to get the output that you want. Your machine's sitting in the shop. It's not operating on your behalf. So that has been a major issue for us, probably the major gating issue in terms of production for us. And why is that? Sounds like a simple problem to fix. Get some new machines or fix the ones that you have. The issue for us has been that for so many years, we managed to whatever cash we had. We weren't making long-term business decisions. We knew what we would like to do, but we did what we could do because of, we did what we could do with the cash that we had. We weren't able to say, okay, let's just raise $10 million more. That's not how we operated this business. We said, we're not going to raise any money ever. Unless it's super accretive. We got to keep the capital structure. Our market value is so low. This is crazy. So we just got to figure it out with what we got. And that's what we did. So what do we have now as a result of that? We have many vendors machines. So instead of standardizing across one or two vendors, we have probably 7 different OEMs, different manufacturers' equipment. So we're talking drills, trucks, loaders, LHD, all the different pieces to the underground ecosystem. So what is that? Why is that a big deal? Well, that means your mechanics aren't specialized on one vendor. Every machine and every vendor is slightly different. It means you're stocking spares and components for all these different vendors. They are not standardized at all, and you're just a jack of all trades. Then, from a maintenance point of view, you also don't have like a core relationship with the vendor. We bought most of these machines used, refurbished from somebody else who was downsizing or shutting down, or at auction, that sort of thing. It was real hard scrabble time. So we did what we did. What are we doing to fix that? It's a gradual process. You show up. You went to our mine last year versus today. Looks different. Come in another 2 years, it'll look very different again from an equipment point of view. We've already placed orders. We're standardizing across 2 vendors or attempting to. And over the next 36 months, we'll have largely phased out all that old equipment. So our availabilities will go up. Our maintenance, capabilities from our maintenance team will go up because we can focus on training around those, and everybody will look better because we'll focus on stocking critical spares and parts for those vendors naturally. So it's a fix that takes a few. It doesn't make sense for us to scrap our whole fleet and try and buy everything new tomorrow. It makes sense from a financial and execution risk point of view to phase it in. And that's what we're doing.
By the way, in your plan, are you assuming any, mill expansion?
No, we're just leaving it as is. Yeah. And same thing for Summit. So we definitely have an ability to expand that mill. There's space and there's ability to expand our tailings facility. And we would very much like to do that. Right now, from both because we're permitted for a certain mill and certain tailings capacity, we want to get restarted. We want to get any of the gremlins out, make the mistakes that we're going to make. And, we had 99 of them written down on in a file, and it'll be 110 that comes up. That's something we never predicted. It's mining, that always happens. So we'll make our mistakes. We'll get the gremlins out, and once we're operating and generating free cash flow, we will expand that mill. We'll expand that tailings facility, which will allow us to expand our mining throughput. and allow us to tackle other mines in the area, either by buying them, somebody else's mine that they've put some work into developing a resource and getting a mine plan ready. Getting a prospective past producing. There's many of them. The town that we're based in, Billy the Kid lived in that town and worked as a miner there. Whatever it was, 200 years ago. So there's a huge history to mining in the area. Lots of high grade gold and silver. Lots of potential. The choke point is permitting a mill and tailings facility, and that's what we got.
So let's talk about, so you're assuming we're projecting in your plan $1,300 per ounce in all sustaining costs for next year at the Galaxy. Do you think that's reasonable? And could you add some color to that?
Yeah, it's it's not the distant future. So it's a few weeks away before we start next year. So it's not some great complex fairy tale that we have, a bunch of things have to happen. So, if we execute on our plan, we will get there. We have inflation in power costs. We have inflation in salaries, a little bit of inflation in capital equipment, not surprisingly little so far. And it's all factored into our projections. And for us, it's really just increasing the volume. So the denominator is getting bigger and that unit cost is going to go down. One of the things that's benefiting us, it's a constraint, but it's also a benefit, is we have a very simple process. So we have refractory ore, which is a problem historically and today. So it's very hard through conventional chemical process to extract the gold. And not impossible, but it's hard to get an economic amount of gold out of that ore. So what we do is we run a relatively simple crush mill float and produce a concentrate. And we ship that concentrate to an off-taker, and that off-taker blends it with other ores, probably copper ore. It's not really our business. And it goes off to a smelter where you don't have that, they don't have that issue of unlocking the gold because of the process that they're using at the smelter. And the off-taker is making a profit because they're getting a gold credit from the ore, the concentrate that they're sending there. So why is that a benefit to us? Well, number one, it was less Capex because we didn't have to build a CIL plant or a BIOX, all that sort of stuff. So upfront costs way down. There's less OpEx. We're not running the CIL plant. We don't have a gold room. We don't have electrowinning. We don't have any of these energy intensive or chemical or input intensive. So OpEx goes down. Execution risk. Again, we're running the simplest part of it, crush mill float. Execution risk goes down. So that's why we're the beneficiary of it. Now, with the higher and higher gold price, the economics of this just get better and better. And we have this lower cost process where we're losing less and less of the economics because of the better environment. It really benefits us. And it's, what should have been a, fundamentally higher cost production site, being Galaxy with refractory ore, is turning to a lower cost, like bottom, not bottom decile by any means, but bottom half in terms of costs. And, it's, we think we can keep it there because we're going to be increasing that denominator quite a bit in the next 5 years. So we'll have inflationary pressures just like everybody else. And we're factoring some of that in the model. We might be surprised. I think it will be worse than anybody thinks, but that'll be good for gold. That'll likely mean gold will be much higher as well.
I guess on top of that, what payable recovery do you get for your gold in concentrate?
So right now it averages about 80%. So what does that mean? If we ship 22,000 ounces of contained gold next year, we get something like just under 18,000 ounces of gold payable to us, like 80% of that number. Where does the rest go? That's the profit for the smelter and for the off-taker. So in return, where do we get paid? We just truck it 200 kilometers from our site to the off-taker's warehouse, and we get paid. Anything else up afterwards, if there's any discrepancy between their assays, our assays, and at the smelter. So they're taking the shipping risk. They're doing blending. They're doing whatever they're doing. It's none of our business really what they're doing. All we care is that we got paid, and presumably they're making a good profit from it, and an even bigger profit at higher gold prices. So that's great for them and it's great for us.
And the treatment and refining charges, how much do you pay in that?
Nothing. Well, we did nothing because we're not. That's out of their end.
What do you view as the biggest execution, if there is one single risk with executing on your plan, increasing production, keeping costs flat, etc.
So, in terms of both operations, I could say the same thing as staffing. So, we're obviously in a better position with Galaxy as we already have a core management team, but we have, as we're expanding, we have to hire quite a few people, and it's obviously more competitive in a high gold price environment, and you're also battling to keep your top people. We have a lot of things going for us. So that's the long-term bonds, the very nice location where we're operating. Those things are going in our favor, but that's still a major thing. I would have had a different answer a year ago. I would have said, well, to make sure that we have sufficient cash to make the investments that we need to make to keep this thing going and to keep it growing. And we're in a very different position now. So we're out from under debt. We had a bunch of accrued payables. We're almost caught up on all of those. We will be in the next few months. All this sort of underinvestment that we had in normal course maintenance and sustaining capital that we're in arrears several years on, we've caught up. We've done it all. So that cash constraint's gone, and that's really de-risked us from a financing and now operating point of view. So it's really staffing. Same thing goes at Summit. Very simple operation. Again, crush, mill, float. It's deja vu all over again for us from our Galaxy operation. And we were doing contract mining there. That was, I think, a key decision for us because staffing on the mining side would be the hardest by far, and the ability that adds a lot to our operating cost because obviously there's a margin in there for the contractors and also the amortization of their equipment. So our OPEX goes way up, but our CAPEX came way down because we're not buying any of our own mining equipment. Execution risk also went way down because we can push contractually a lot of the key performance indicators and requirements onto the operator, and they'll either deliver or they won't, and we'll pay or we won't. So that's, to me, in a high gold price environment where I have a risk of starting and staffing issues, that's a no-brainer. I'll do that 10 out of 10 times. We still have over 20 hires to go. We're in a kind of remote community in New Mexico, and that's both positive and negative. It's positive because a lot of the people that worked there before are still around, and there aren't many competing industries there. So there is a lot of unemployment. So hiring the admin people and sort of the base of the team is not that hard. Getting highly skilled people to come to a small mine in a relatively remote part of the state, that is a challenge. So I think we've got a great hire lined up for a general manager, and we're going to have like some of the other pieces falling into place on the planning and milling side. And it'll come together. But I would say, I still view that if I, what percentage of my brain do I spend worrying about stuff on that one? Same as Galaxy staffing.
Yeah, 20 year plus resource life on more mine life on Galaxy. Do you plan to spend any money on exploration next year?
We will spend a very limited amount on exploration, and it'd be extremely economic and targeted. So remembering that we're underground, we're in the ore bodies, we're able to do some very precise exploration work there. And we have, this is, mining started this location in the 1870s and 1880s. So there's a lot of knowledge of what's there. There is more gold there. There's a lot more gold there. And we have a lot to go at with what we already have. But we would still, like the Galaxy ore body out of the 20 some ore bodies was more recent find. That we would love to find another 2 Galaxies, and we will. So we'll have some very targeted expenditures there. So well under $1 million though. But what we can accomplish from underground with well under $1 million, where we're already doing, we'll call it like mine plan, like drilling, normal course drilling associated to running our mine, adding some exploration work to that, huge leverage. So like a lot of opportunity for us. Similarly on Summit, we looked at, why don't we do a new 43-101 resource report, using higher gold and silver prices, we'll get a whole bunch of free gold and silver. Like we'll get a big boost in our resource, and it won't cost us very much. And we decided we're not going to bother to do that. Instead, what we're going to do is initiate a exploration and confirmatory drilling program once we start mining. So again, we're in the mine. It's much cheaper to do. We're already mobilized. We're there. We have to do some of that work anyways, just for like normal course mine planning. And we're going to add some exploration element to it. So there we have a more of a motive. Why is that? Because we want to be able to extend that mine life, and we want to expand the output. So if we can show a larger resource, we can justify expanding the milling capacity and the tailings capacity, and growing the operation. So there's no reason why this can't be a 25,000 ounce a year producer for a very long mine life. Probably not going to be a 100,000 ounce producer, just like some call it physical constraints to the locations. But getting it up, adding to that production base, amortizing it over the same fixed cost, profoundly positive financial implications for us.
Awesome. And also, by the way, besides exploration, will you have any growth capex at Galaxy that isn't included in the all-in sustaining cost?
No. Nominal expenditures that are planned, what I'll call it more mostly is going to be sustaining capex. Growth capex, no. All our capital expenditure at Galaxy is just normal course underground development.
On Galaxy, do you have any issues with power, or have you had any other issues with power?
I'd say I'll highlight two things. So number one, I think it's an important thing to focus on is power. We have not had any real issues related to power. I expect that we will. So it's more like a when, not if. And we've been fortunate, just it's kind of a quirk of our location that I think that we haven't had any significant issues of like power cuts or rolling blackouts or any sort of other than voltage fluctuations, which is that you're going to get that anywhere. Issues like that, those do come up, but it's something that we can plan for. So our maximum draw is it forecast to be it's not going to go over 5 megawatts of power requirement. I'm chairman and founder of 3 different energy companies. First 2 acquired. Still chairman of a private power production company, so I have a lot of knowledge in that area. We will build our own solar generation facility. We own 980 hectares of land freehold. Most of it's hilly. It's not very good for solar, but we're already looking for locations where we can put the panels. We can internalize that. The price of storage, i.e. batteries, has plummeted and is going to continue to go down. So it's not a 2026 thing for us, but 2027 or 2028, we'll look to internalize kind of like 90+% of our power requirements. And just back of the envelope numbers, that's about a 1-year payback in terms of the already relatively high power prices. So it's you could call it OPEX if you want. You don't even have to amortize that, and you're going to make your money back on it. And that's from a cash flow perspective, de-risking the operation by taking the availability of power out as a major risk. That's hugely valuable as well. So that's on our to-do list, and it was further out on our to-do list before this year and these gold prices, but it's not in any of our projections, but I'd be very surprised if we're not doing that 18 months from now, talking about internalizing substantially all of our power requirement. So that's the first thing. The other one is water, and it's not the shortage of water, it's the too much water category. So we have had issues in the past with flooding. And, we've done a lot of work over the last few years to mitigate that. And in fact, we've seen worse storms and water levels than we'd seen in the past, and they have not caused us an issue. So what have we done? Building spillways, additional retention walls, berms, ways of collecting and diverting the water. And also I'll call it a biological solution. So, they've even in Africa, we're audited and we're reviewed and things like in terms of what the flora and fauna are in our area, and we have an impetus to focus on indigenous plant species, but there's a variety of plants and vegetation that we've planted which will increase the soil, like the retention capabilities of the soil, reduce erosion, that sort of thing. It's virtually costless for us to do it, and it's incredibly effective. Like it's more effective than any wall you could build. It's just planting native species that are going to thrive there. And the more green, the less problem you have with excess water. It just it's the single best solution. So far so good. In 2024 and 2025, we saw some really bad storms, and we had no downtime associated to them. So the things that we have been doing have worked well so far, but something that we'll continue to invest in because it's, I think it was 3 years ago, we had a bad storm caused a minor landfall, which, buried part of our mill, caused us no long-term damage, but we were down for weeks dealing with that, and that's obviously something we'd prefer to avoid in the future.
I know this fluctuates, but could you give some sense on how much does silver contribute to the revenue mix at Summit?
It's going to vary between 40% silver to 50% silver. So we're doing a revised mine plan. We're using an external party to do that. So it may change a bit, but the mine plan is very much driven, like where we move around the ore body and which areas are focused on by your ratio, gold silver ratio. That's part of it. The absolute prices are obviously part of it as well. But at one extreme, it's probably 40% silver. The other, it's 50%. So that's kind of the ratio. So on average, about 500,000 ounces a year of silver production.
And what permits, if any, is remaining? To actually be able to start. Okay, there isn't any.
Nothing. No, nothing. So we have water. We have the tailings. Everything's there. So we do have notices that we've posted and different process that we've undertaken, but as it stands today, we don't require any additional permits.
And what is the Capex spend plan for next year, which essentially will take you, start up production and get close to commercial production by the end of the year?
The maximum cash outlay is just over $3 million, and that's almost entirely working capital. Why is that? It's because the mill's already up and running, so we have less than $100,000 of Capex remaining, which will make those expenditures like a bearing replacement, liner replacement, and alignment. That'll be done closer to actually operating, which will be operating that mill at the end of Q2 and into Q3. So that's de minimis, and then the rest of it's largely working capital, mobilizing the mining contractor. And capital related to underground mine development through the contractor. So, very little. It's a small operation, and it's not one where it's like a full restart or something that was permitted and past producing once upon a time. It stopped with the drill actually in the face, like mining. Like people found out they weren't getting paid their salary the next week, turned the machine off, and just walked out of the mine. So it's in the ore body. We're producing the first. I think we could probably, hopefully, exceed that production target for 2026, but we put in a very modest number there, and even at 2,000 ounces, it's almost $10 million of revenue at today's gold and silver prices.
So let's talk about the spinout, which is a good way to create unlock shareholder value, which is at least for now planned for Q1 next year or the year in 2027.
Oh, it'd be
after, okay, so sometime maybe mid 2027, we'll see exactly, but some in 2027. But so there are a few ways to do this. You can just let it merge for another company. You could let it do a listing on the TSXV. Maybe if it's as enough critical mass, do an IPO on the NYC. And also, do you think Golconda will keep a substantial shareholding? Or do you think all shares will be, just distributed to you?
It'll be driven by tax for sure, but the most probable path forward is we keep a majority shareholding. We listed initially on the TSX because it's very easy for us to do so, like a partial spinout. We would get a quotation in the U.S. market, OTCQX, virtually immediately after listing. So that's our shortest path to being trading in U.S. dollars in front of U.S. investors. And then as we have a year of audited financials as a standalone company and meet all the targets, we'll upgrade to a full listing in the U.S. market. Our expectation is we'd be diluted over time because there's going to be opportunities to do transactions with that company, which are interesting. And just very briefly on that, maybe we're only producing 12,000 ounces a year at Summit, but that at today's prices, that could make over $25 million a year. That profitability, that equity component could be the equity component to build several other otherwise somewhat stranded projects in Nevada, in Utah, in Arizona, possibly in New Mexico. And we'll have the management team, we'll have the cash flow, we'll have the vehicle. And for us, we could have a transaction that really moves the needle, which we'd have to, dilute by issuing shares to merge with somebody, but we may not need a single penny of additional equity. So again, repeating our model and just doing it with almost entirely focused on the southwestern United States. And there are a lot of projects there that are subscale, like sub 100,000 ounces a year. A lot of them that are very interesting economically, 30, 40, 50, 60,000 ounces a year. Great projects. Short path to profitability, pretty easy to permit, and hard to see who's going to build them. Because even it's great capital markets and you could raise the money, you could raise the equity, people will show up for the debt. You also need a management team around it. So all of these things have lots of pieces that have to go into them, and we show up with several of them.
So then, next year, obviously, getting Summit into production is a big capital allocation priority. What other? I mean, how do you think you will spend, or how do you think you will use the free cash flow from Galaxy generated next year?
That's just it. If there's another deal presents itself, we're interested, but it'd have to have the same characteristics. Otherwise, it's free cash flow. It's cash flow after Capex. It's cash flow, like Summit doesn't really take much, it's $3 million. So, and then it's generating its own free cash flow in 2027. So it's actually free cash flow. It's below all the lines. So yeah, we'll see. It's either if it's another project that meets all our criteria, or, come back to shareholders.
Excellent. So with that, where do you envision Golconda Gold in 2 years from now?
2 years, like if let's the base case, like we haven't done a transaction, any other mines, in which case Summit's now in production. Summit spun out. We're maybe still the majority holder of Summit, maybe not because it's done another deal, but let's assume we haven't done anything. So then we've taken Galaxy from kind of 10,000 ounces into the mid 20s over the next 2 years. And at these gold prices, we're producing a huge amount of cash flow. So in the first case, my focus is going to, if we're trading at 3 times cash flow, 4 times cash flow, even 5 times, I'm just going to buy back shares. That's my preference versus dividend. I'm in no hurry to get the cash in my pocket. That way my ownership is going up. It's a bit of a floor under the share price. And it's just long-term, it's good for everybody. And then if, we're in some sort of let's see what the conditions are like for the gold market. I have a feeling it's going to get much better, and the shares are going to trade at much higher valuations, in which case maybe we don't want to buy back shares anymore and maybe prefer a dividend. So that's certainly on the table, but we will look at whatever's the most tax effective. And we're not adverse to looking at other opportunities. There are other opportunities out there that still meet these criteria. It just might be a bit more expensive on the entry, and that's okay. Gold has tripled. So it should be more expensive on the entry.